Hello guys, welcome back to my channel. So today we will be discussing about index funds and why should we be investing in them. So basically an index fund is a mutual fund designed to mimic the market like Nifty or Sensex. And the basic aim of index fund is to match the risk and return of the market based on the theory that in the long term the market will outperform any single investment. Basically index funds follow a passive investment strategy compared to an active investment strategy. Let us find out how index funds actually work. So let us see how index funds actually work. So basically indexing is a form of passive fund management. So what the fund manager does is he builds a portfolio whose holdings mirror the securities of a particular index like Sensex or Nifty. This means they aim to maximize returns over the long run by not buying and selling securities very often. And the idea is that by mimicking the profile of the index, the fund will match its performance as well. So let us see the major differences between index and active funds. So investing in an index fund is a form of passive investing where you're investing passively and you're not doing much changes to your portfolio. Whereas in active funds, the opposite strategy is applied and you're actively selling and buying the stocks. And in case of index funds, the expense ratio is very less compared to active mutual funds. And in case of active mutual funds, more expense ratio due to research and more transactions regularly. Let us now check how the performance of index fund and active fund over the years. So if you can see, there are the top five index funds are present, and their averages per year for 1 year, 2 years, 3 years, up to 20 years CAGR is present. And if you can see the large cap average CAGR over 1 year, 2 years, and up to 20 years. So if you can see that the average is not much difference, and even if you take into account expense ratio, you will be getting less than what index fund return is giving you. And if you see the number of large cap funds that have underperformed the Nifty 50 over the years, you can see that 57% of the 20-year period have not performed better than the Nifty 50. If you take UTI Nifty index fund, you can see that even that 29% of the funds do not perform over 20-year period. And if you can see, then doesn't really make sense for most of us to invest in other active mutual funds if it is not beating the market. So let's see the pros of index funds. It lowers your risk through diversification. It has a very low expense ratio and it has strong long-term returns. It is very good for passive buy and hold investors who do not want to invest directly, and it also has lower taxes for investors. So let us see the cons of index fund. It is vulnerable to the market swings and crashes. It has a lack of flexibility as you will be sticking to the indices, and it has no human element or intervention. And in the short term, it has limited gains. So the final question is: should you be investing in index funds? If you are a long-term investor, it is a very good option for you. If you are not directly able to invest in stock market and you don't know which fund to choose, index funds are a very good option, and they are also low cost option for a well diversified portfolio as a expense ratio is very less compared to the active in mutual funds. Thank you for watching the video. Please subscribe to the channel and also like and share the video. Thank you.